1,930. Midcap index is up about 0.25%, and I think the small cap index will come up. So these are, decent sort of starts to begin the session. The Nifty heat map will give you a quick sense of how we are starting within the first few seconds of market open. Look at that. I mean, 2-point change in the Nifty, neither here nor there. Dr. Reddy's on one end and Eternal, that is Zomato, on the other end. This is again a very evenly balanced kind of screen between green and red. But let's get to individual names, and I guess, as Rima was pointing out, Tata Tech is one of them.
Yeah, absolutely. In fact, let's start with that stock, big newsmaker of the morning, with the acquisition taking place. So we've got about a 2% up move on Tata Tech. Back to the Nifty names then. There's some cool-off in IT after yesterday's hard run, rather last week. Remember, the IT index was up 4-5% last week. Infosys, TCS, Wipro, all these stocks are seeing a little bit of red as the day starts off. There is some red on HDFC Life, on Shriram Finance, on Bajaj Finserv. So the non-bank financials, they are starting off on the softer note. But on the upside, there's Eternal. There's some buying coming back to auto names like Hero Moto, Bajaj Auto. They're again finding some takers. BEL on Friday, defense had a very, very powerful move. So it seems that BEL is continuing from that sort of note. SBI, ICICI Bank, minor gains. But all put together, it's nothing very major. Nifty only up 10 points as of now. Mangalam.
It's only up 10 points, but it's a positive because the GIFT Nifty was actually indicating a 30-point downtick at the open. So to that extent, it's been good, just meandering below the August 21st level of 25,154 for the frontline index. But a lot of broader market names are doing well. Straight off the bat, we have nearly 3 stocks advancing for every stock which is declining. And among the stocks which are gaining, Tata Tech, we spoke about the acquisition. RVNL is doing well. So along with defense is the rail pack, which is doing well too. Vedanta is another one, which is up around 2%. So issues with SEPCO resolved. That stock is, fairly well bid. On the way down, though, we have KRBL that stands out, down 11%. One of their independent directors has resigned, citing corporate governance issues in the company. So opened about 7-8% lower and now is seeing a fair amount of sell-off. In fact, down about 12%. The other one which is seeing some profit booking is Latravenues Tech, the makers of Ixigo. That's down about 5% as well. So some bit of profit booking is what we've seen there. But here as well, on the way up, we are seeing some traction on RailTel. They've won an order. In fact, one of the many orders that they won over the last 2 weeks or so. So that stock fairly well bid. Pharma, along with IT, is the one which is taking a pause for breath. So we have Strides, which is lower by about 1.5%. Aurobindo Pharma down about 1.5% as well. Zydus Life is seeing some profit booking. So more export-facing names pausing for breath today as against domestic names. All of them doing extremely well. Case in point, something like a Hero MotoCorp as well, which is higher. So by and large, a decent screen, one would say, as compared to what the GIFT Nifty was indicating, and especially after putting on an 8-day rally, the broader market's doing relatively better. That should suffice as a no big, bang sort of opening, and let's see whether it steadies out.
Market breadth is about a clean 2:1 in favor of advances. So this is, it's a broader market play once again. So let me just quickly highlight some of the other movers, right, which are making a go for it. Cochin Shipyard is up 3.5%. It's the biggest. It's at the number 4 position with regards to volumes and gains. I don't think we highlighted RailTel. RailTel is up 5.5%. It's a big one, 400 on RailTel, and very large volumes. Shakti Pumps had a very large move on Friday. So basically, from Thursday's close, which was $800, Monday morning it's at 900 rupees. So Friday was a big one, and today is a big one as well. 81,000 shares coming through. I mean, of course, it's come off from about 1,050 levels. Generally, over the years, it's done phenomenally well. EIL, Engineers India, 3.5% higher on that one. Tata Tech, of course, we highlighted. Anantraj is up about 4%. Data Patterns is up about 4% or so. Astra Micro is up about 4.5%. I think a lot of these smaller defense names, right, which are mid-cap defense names which are doing well. Apollo, of course, we highlighted earlier as well. So, yeah, I mean, DCX is another one which is up about 3% or so. But as I go down the list, volumes thin out a little bit. So, watch that. I think KRBL we highlighted. It's the second largest volume-led loser, 11% knock on KRBL. So, at about, 396. Look at the volumes, 134,000 shares already. GMDC, I think we put out with Hormuz as well earlier, 2% lower. There is Moschip, which has had a supercharged move from 160 kind of levels straight to about 270, taking it a bit easy now. Ixigo, what a mover, right? I mean, Ixigo was up as of, I think, Friday or Thursday's close, up 90% in 2025. It's up 72 now, so it's come off the highs. The high is about 330. Stocks at about, 289. It's down 6%, 6.5%, but huge gains. Last year, when the year listing, stock did nothing, and it just picked up very, very sharply. MobiKwik is another one of those shooting stars, 2.5% lower today. Ola is down 1.5%. Again, a name which has done very well, under 60 rupees. AB Capital, and I can go on, Sundaram Finance, Precision Camshaft. But, again, on the downside as well, as I sort of run through the names, volumes start to trickle and fade away a little bit. More names in a bit. Gautam Trivedi is with us, managing partner at Nepean Capital. Gautam, good morning. Great to have you with us here. Usually we have you here in the studios. I guess it's the rain.
It's the rain. I was hoping to make it to the studio, but I guess you guys are brave enough to venture out today.
We had to send a couple of rescue teams to get people into office.
Floats and all outside. Oh, good call, Gautam, of not coming in. We can tell you that. Good call. Today, technology works, and let's make use of it.
Absolutely.
Exactly.
Gautam, so let's just start with a bigger talking point, and we'll drill down to individual stuff, right? 20% underperformance. India is up 1% in dollar terms this year. The MSCI Asia ex Japan is up 21%. This year, YTD. Of course, it's. I guess what happened before over 21, 22, 23, etc. wouldn't matter. But how do you look at this, Gautam? Is there, people look at the numbers like this and say, well, maybe at some point it'll turn in a very, very rapid and ferocious way. Is that the way to look at it? Or you think, maybe the underperformance stops, but you got to have real solid reasons for the market to go back into up and up kind of a phase?
Yeah, I think the way to look at this is that unlike domestic Indian investors, retail investors, FPIs have a choice of where to invest, and not just within emerging markets, but it could be whether to invest overseas at all or not. And I mean overseas ex the United States, because that's where bulk of the money comes from into EMs. Even if it's routed via Singapore, routed via London, a lot of the money, of course, does emanate from the United States. So when I look at that, and if I look at India in that context, we had basically two issues: high valuations. But again, that was never a big deal because we had earnings that were growing at a pretty steady double-digit clip. But now we have an earnings slowdown. So if you look at the earnings situation back in the States, first quarter of this year, the S&P 500 posted a 12% earnings growth in EPS. So EPS growth of 12% for the S&P 500. Now you might ask me, wait a minute, but the Max 7, what about them? Aren't they contributing most of it? Yes, it's 28% earnings growth for the Max 7, but the balance 493 companies posted a whopping 9% earnings growth. That's even higher than the year, and that's a $30 trillion economy. Now, the second quarter of this year, the S&P 500 posted 11% earnings growth. So if you've got strong earnings growth in your home market, of course, that may slow going into the third quarter. But if that's the kind of intensity of earnings that you have back home, you think twice about potentially putting money into emerging markets with all the political risk, currency risk, and other issues. So I think from an India perspective, and more pointedly to your question, FPIs need to see earnings growth come back. And if that doesn't come back, I suspect they will continue to sell. We've seen roughly about $16 billion of selling year to date. But if I look at it over the last 12 months, it's $28 billion. So India suffered the highest in terms of FPI selling across all emerging markets.
But Gautam, sorry, allow me to come in over here, but that's exactly the point, right? We know that it's earnings which is the missing piece, which is why FPIs are going, elsewhere, wherever they're getting better earnings and better valuations. But that's the point. What is the kind of earnings pickup? Because we've got the RBI cuts, we've got the income tax cuts, we've got the GST cuts. So now what is the kind of earnings pickup that you are estimating? I asked the same question to Vetri Subramaniam last week on the show, and he was actually not expecting a very big bump up, a huge surge in earnings. That was a sobering thought. But what's your view?
Yeah, so my view is that let's look at where the rest of the world is, or rest of at least Asia is, with respect to earnings. And I'm talking about calendar 26 next year, consensus earnings estimates. Korea 17%, Taiwan, China 16%. We're between 12 and 15%, depending who you talk to. So I think those markets are trading at half the valuation of where India is, and they've got, if not the same, but a higher earnings growth for at least next calendar year. So if you look at those numbers, frankly, if you were sitting outside taking a decision in terms of allocating assets, where would you rather put your money? So that's one. Secondly, if you even look at just the absolute performance year to date in dollar terms, Korea is up a whopping 54%. Taiwan's up 25%. China's up 38%. And as Prashant just said, we're up literally 1% in dollar terms. So I think to expect FIs or FPIs to come back anytime soon would be a bit of a struggle. With respect to what you said about earnings growth improving, the big hope trade here is that GST 2.0 will actually help significantly improve earnings for the second half of the year. I personally wish that happens. And if not, I think we will have a systemic problem on how to revive the broader economy.
We take that point. And so, be that as it may for the markets and the overall earnings, etc., we're here to look at individual sectors and opportunities where one can deploy money and, make it irrespective of where the institutional flow is coming from. Financials is one space that people have been incrementally positive on. In fact, for a while, they say that if the GDP has to improve, if things have to look a lot better, financials is one space which is offering that sort of comfort. And in that also, I'm looking at a couple of these individual names. Northern Arc, something that Prashant spoke about in terms of volume gainers. It's up 5%. There were a couple of brokerage initiations over the weekend. We had ICICI Securities believing that, the company trades at sub 1-time book, deserves to trade at 2 times at least. And we have DAM Capital expecting a 39% CAGR over the next couple of years for this counter. So, Gautam, while the overall market earnings are expected to grow between 12 to 15%, there are individual pockets where growth of over 30%, and in this case, 39% is expected.
Yeah, no, I take that, but I still think that this reform in GST really is going to be the key to broaden the earnings growth. And if that doesn't pick up for whatever reason, then like I said, we have a problem. So it impacts everything further down. So somebody asked me the other day, isn't this going to be great for cement companies? I said, well, cement is a B2B business. So it's great for people who are using cement, but that doesn't necessarily translate into lower, for example, real estate costs for people looking at buying a home. But when you look at the B2C businesses or B2C products that have now gone to 5% or even 0%, that's really where I see the big pickup coming. And frankly, if that's going to result in savings for individuals and that money gets plowed back in some other sector into the economy, that's, I think, when we'll see the pickup in financials. I think it's a little early to start betting so strongly on financials, unless the DAM Capital note that you're referring to does talk about the full impact of GST being morphed into a pickup for that NBFC.
Right. And so in that case, what other sectors are you betting on? If it's GST, then obviously the intuitive ones are consumer staples, some of the auto names which stand to benefit the most. And as we move into the festive season, what are your thoughts here?
I think white goods, automobiles, again, it's a hope trade, as I said, and the fact that people will end up, buying these a lot stronger than they ever did before. So I was talking to a bunch of automobile dealers over the past about few weeks after the GST announcements, and they really had, were upset about the fact that the effective date is September 22nd because most of their customers basically are holding off buying cars. So this should be a huge positive, I think. Frankly, I'm a big fan of this GST 2.0, and I think that will significantly help improve economic growth in the country and bring consumption back. But like I said, it's early days. Let's wait to see how this pans out. We'll know so in the next 5 to 6 weeks.
Yeah. Just make a couple of mentions, stock mentions here. Pull up Anantraj if you can. Anantraj is up 6%. Not on small volumes, by the way. Fifth largest volume-led gainer right now. So the government basically has proposed a tax exemption of up to 20 years for data center developers, provided that they meet targets on capacity addition, power usage, effectiveness, etc. So this is on the back of a policy proposal at this stage, at this point in time. So there's a sharp move higher coming in there. You know, I mentioned Railtel, but it's Railtel, it's Ircon, Texmaco Rail, RITES. The entire railway pack is once again, I remember year and a half back, I mean, that entire space topped out, but after going up, 5, 6, 7 times. There is, Cafe Coffee Day, 14% higher, $25, has got volumes in it. And that's why I'm making a quick mention of it at this point in time. So there is that. Which is going on as well. Surbhi, yeah.
Since we were, pointing out KRBL, just very quickly mentioning this, if you're wondering, I pulled up the resignation letter, which the company obviously has to file with the stock exchanges, and just some of the points of what this independent director has alleged in terms of corporate governance. So he's saying unjust write-off of certain export receivables without adequate deliberation, instances of information being withheld, impacting decision-making, concerns regarding the use of CSR funds, arbitrary distribution of variable pay to persons holding office or place of profit. So those are the kind of, there's a nature of allegations. Let's see, we've reached out to the company as well, and hopefully they will come on air and clarify their stance on this. So some stocks in focus. Since we're talking independent stocks, Sud is back with us to talk to us about Vedanta, at least one of their, arbitrary issues or arbitral issues with the Chinese entity, that seems to be getting resolved. Sudarshan?
So it was a long pending issue related to SEPCO, and it's for the power business of the company. Now, over the weekend, company has announced that that issue is resolved. And now, basically, for this NCLT hearing is no longer warranted, and it helps in companies' demerger plan that company might go ahead going forward as well. But the another issue that everyone would be focusing is the next NCLT hearing, and it's related to the plea that was filed by Petroleum Ministry, or say MOPNG, and that hearing is scheduled for September 17. So over the last few months, stock has been in the focus for the various reasons. But for now, September 17 is the most important date for the company.
All right, we take that point. Meanwhile, Prashant spoke about Revenues Tech, which is Ixigo. I think it's a sector-related thing where we are seeing some profit booking. We have Yatra, which is lower. We have Revenues Tech, which is lower as well. So a couple of these holiday makers, travel companies, seeing some bit of a decline, anywhere between 4 to 5% on either of these stocks. Yatra comes up for you. That's lower by 4%. We have Revenues Tech, which is down by 5% as well. And both of them have actually seen a big move in the last few months itself or so. 70% plus for this one, and Yatra itself is up nearly 40%. The one that was lower though, KRBL, it's down 9% now. Vamakshi joins in. Vamakshi, not looking very good from a corporate governance standpoint here.
Absolutely, Mangalam. The news flow in KRBL is that independent director, who is Anil Kumar Chaudhary, has tendered his resignation. Now, in his resignation letter, he has actually written that the present dynamics of the board are inconsistent with the principles of effective governance. In fact, some of the key issues that have been cited by him in his letter include inconsistencies in the recording of minutes of the board as well as the committee meetings, instances of information being withheld impacting the decision making, which is a very serious matter as far as governance is concerned. Unjust write-off of certain export receivables without adequate deliberation, concerns regarding the US use of CSR, as well as significant changes to object clause undertaken without comprehensive discussion. These are just some of the few concerns that he has highlighted in his letter, and he has further written in his letter, and I quote, that in such an operating environment where dissent is suppressed or sidelined, remaining on the board would compromise both my professional ethics and obligations. Largely some governance concerns creeping in for KRBL, and resultantly the stock is lower.
All right, and lower sharply. Vamakshi, thank you very much. So that's context for what's going on at this point in time. We've got about 1,600 stocks on the NSE which are higher, and about 950 odd stocks which are lower right now. So that's the picture. ITI is shooting about 6% higher right now, 327 coming through. Gabriel, 1,280 on Gabriel, 4%. So, many names. There is Themis, which is a recent listing, THEMIS, 10%. 134 on very large volumes coming through. There you go on your screen now. So, Inox India is coming up with about a 3% pop. So it's a fairly broad kind of list, but I must say, it's early actually. I mean, I don't think one can make a judgment of volumes or anything, and some usually it has broadened out and volumes have picked up. But for now, beyond the top 15 odd names on the NSE, volumes are kind of lackluster.
You spoke about Anand Raj. On that, the volumes have actually been a lot higher in the first 15-20 minutes as compared to what we've seen earlier as well. So first 15-20 minutes on Anand Raj, the volumes have been nearly 2 or 3 times what we usually see on the company. 21 lakh shares traded already. On a regular basis, you see about 7 to 8 lakh shares trade on that counter in the entire day. And we have 20 minutes of trade so far, and 22 lakh shares have been traded. But let's talk about the consumption space. Sanjeev Asthana, who's the CEO of Patanjali Foods, joins us now. And we'll be obviously focusing on the consumer sentimeter, the consumption centimeter. Main points to discuss: the impact of GST reduction on their business, the sentiment ahead of the festive season, and more importantly, outlook on raw material prices and the company's plans to scale up their home and personal care business. Thanks a lot, Mr. Asthana, for joining in. For a business like yours, where you do have the entire portfolio, right from edible oil to home and personal care to toothpastes, and also at the same time you have food, etc. If you could give us on a blended basis, what's the reduction in your GST? Because from what we look at your portfolio, it seems like your entire portfolio has now come down from 5%, some from 12%, some from 18%. So if you could give us a sense on what the overall blended reduction of this is, and what is the likely incremental volume expected from these lower rates?
So 2 parts to your question. One, that reduction, what has happened is edible oils has largely been untouched. It used to be at 5%, so pretty much it remains at 5%. On most of the HPC products, it used to be 18%, barring a few, which were at 12%. So they have got down to 5% now. A lot of food products, which were earlier at 18%, they are at 5%, and some were in the category of 12%, which has gone to 5%. So on a portfolio basis, our estimation is that close to about 10,000 crores would move towards a 5% bracket, and about 2/3 of the business will pretty much remain at 5%, which used to be. In terms of the growth, what we are estimating is that sudden decrease in the GST would not mean an uptick in the consumption straight up. But 2 things are supportive. One is that, the festive season is around the corner. So we do estimate that, a 13% reduction from where it used to be is pretty substantial cut, which should spur the consumption. And likewise, on the food side, as the festive season kicks in, we believe that over next couple of months, we should see an uptick of 300 to 400 basis points. It could be higher as well. But 2 parts which combine. One is the income tax relief, which was announced earlier, which means more money in the pockets of the middle classes, and the reduction in the cost, I think, should be positive to the consumer sentiment. And company like us, I think we should have minimum 300 basis to 400 basis points of uptick in the sales in the coming months. But that on an immediate basis, I don't estimate will happen in next 1 month. But in a couple of months down the line, it should settle down and we should reach an equilibrium.
So, Mr. Asthana, from what you're saying, let's talk FY26 entirely, because this will take a couple of months for all the cuts to be passed on through the system, the new MRP packs. What you're saying is at least 300 basis points improvement in total volumes for this year, or are you saying sales?
Both volume and the revenue itself. So because we have passed on the cut to the consumers and the revenues are captured net of taxes. So irrespective, the benefit when I'm talking of 300 to 400 basis points is basically on the revenue side, on volume growth.
How do you ensure passage of these lower costs? What proportion of your sales comes from these price packs, which is the 5, 10, 15, etc.? And by when will new MRP stocks hit the market earliest?
So 22nd September is the date. So we've already reduced prices on most of our products. The consumer, the distributor stocks, we are tending to taper off to get ready for the 22nd September. And in terms of 5 and 10 rupees packs, that is a more complex sort of planning which has to go in, so that the benefit is being passed on through the weight increase measures. So, for example, on a Nutrela, the soya chunks and soya nuggets business, we are increasing the sort of grammage. Likewise, on the biscuit categories, which was at a very low price point, it's not possible to cut down the prices. So there we are passing on the benefit through increased grammage, and all that work is going on. So we're pretty confident by 22nd of September we should be pretty much in place to pass on the benefit to the consumers, and hopefully that should lead to an uptick in consumer sentiment and our consumption of our products.
Mr. Asthana, just a side note on this, and it's a bit of an operational issue, but just trying to understand. So for the existing inventory where the new MRP printed packs are not yet out, I think the government said that the companies have to advertise adequately and pass on that information to their customers. So does that mean, at least in the interim, maybe just in the month of September or early October, will ad spends have to be higher? What is your interpretation of the fine print of the rules as they've come through for your existing inventory with the old MRP?
No, so absolutely. I think government, is very keen that the companies have to come good on the commitment to decrease the prices. They also want transparency. They also want, commitment from the corporates that everything, which has been reduced for consumers is naturally passed on. And for that, communication has to be done. But I don't believe the communication costs are going to be disproportionately high. It's a fairly marginal cost for most of the large consumer companies. We have already started advertising and communicating to the distributors directly, and also through the, social media channels as well as the national mainstream media that we have already done the communication bit. So I think consumers are pretty much aware. Distributors have been sensitized. That exercise, the date was announced. I think within 3 days of that, we started communicating. And so I don't believe it is going to be of any load in terms of the substantial cost increase on the communication bit.
Take that point. The only issue that a lot of your peers were highlighting is that if we pass it to the trade, to ensure that trade passes it on to the consumer will be very difficult to track. That's point number one. And secondly, for price point packs as well, the existing inventory that there is, you can't immediately exhaust that because the new inventory that comes with, say, one more biscuit than the 5 or 6 that you give in that pack. What do you do with the others? So, be that as it may, obviously near-term transitions, but long-term it is a positive. Let's talk about your edible oil margins, likely margins in the second half, because we've seen reduction from the highs in terms of prices. So what kind of high-cost inventory are you sitting on, and how low are the margins likely to go before they start to improve, and by when do they start improving?
So there was a duty impact that we had when the government reduced the duties, and we were sitting on higher duty paid stocks with us. That is past now. I think this quarter itself we have seen substantial increase. So you would see that the second quarter FY26 we should have substantial improvement, and perhaps we'll get back between 2 and 4% of EBITDA margin that we project. Pretty much we should be in that category this quarter.
So you mentioned that a lot of your home and personal care products were earlier in 12 and 18, and now they'll move to 5. So there should be some benefit, coming in over there. So what are your estimates? First quarter, I think you were at about 640 crores roughly in terms of revenue. Your margin in home and personal care was about 17.7%. What should we expect from this business? Again, I'm talking full year, FY26.
So what we had, Surabhi, what we had projected was that we will do 15% uptick in the overall revenue growth for HPC businesses, which was to come in 12 to 18 months. This year, the target is that, we will certainly be south of that target that we had, because I think next year will be one full year when we'll get the fullest benefit. But we should see definitely a growth rate of 7 to 10% this year. I'm estimating that HPC businesses are pretty robust right now. The integration process, while it is continuing, but it is getting into more completion mode right now. So I think quarter number 3 and 4, we should see substantial uptick. But on a FY26 basis, compared to last year, when we acquired the businesses, we should have about 5 to 7% growth rate in the business. And next year onwards, we should be on a full 15% growth year on year.
So that means that, this 3,200 crore target that you had for this year now comes down to about 2,600 crores. Would that be a fair assumption?
No. We had a target clear cut of 3,100 crores. We should be pretty close to that number between 28 to 2,900 crores for the HPC business overall for this year.
And margins at 18% sustain.
Yeah.
All right, so 3,200 crores turns into 2,900 crores with 18% margins. And the foods business, I mean, staples, they continue to be under a wee bit of pressure as well. In the first quarter, obviously, there was a sharp reduction in margins. Do you believe they go back to that, 7, 8, 9% sort of mark? Are you expecting any time soon?
So there was only one particular segment in that business which had a stress, which impacted the overall profitability. The consumer staples, that we had, which is basically rice and atta and lentils, etc., and sugar and salt. So they were under stress. There was a lot of active inflation management that was carried from the policy side. So that has had an impact. And second was the butter prices on ghee. There was a huge uptick in the prices of raw material, which had an impact. We could not pass on the full prices to the consumers on the cow ghee, and both are pretty large businesses for us. So this we are seeing some improvement there, and I'm confident that between 8 and 10% margin that we have projected for the year, we should be pretty much there for the full year.
All right. You've spoken about all your segments. In the oil business, you said you should get to about 3 to 4% margin sooner rather than later. In terms of volumes, what is your projection here? Because, the Prime Minister, when he speaks from the ramparts of the Red Fort, says that everyone should reduce their oil consumption. The next fight really is on obesity, etc. It may have some sort of impact, right? Because when consumers become a lot more conscious, could there be a bit of a volume slowdown here?
So we are pretty sure that, whether it was Prime Minister's exhortation or otherwise, there was a reduction in the edible oil imports, for the full year by the country itself. So there was some sort of downtick what we saw on the imports, and that also reduced the overall revenue itself in the terms of volume term. But I think this year we are expecting a pretty normal year, and we should see between 2 and 3% increase in the country's volumes, and which should be pretty much reflective of the volumes that we will do as well.
Okay. Mr. Asthana, as we wind up, I have a slightly bigger business/philosophical question for you. I mean, you've mentioned that for you, your business will see better revenue to the extent of 300 or 400 basis points this year. But largely, I mean, there are those who argue that when you talk FMCG, those items anyway will be consumed. It's just that there'll be more savings now because instead of paying 12% tax or 18%, now it'll be taxed at 5%. So the incremental benefits of GST, do they really go to staples, or do they actually go to other, discretionary consumer companies, whether it's, ACs or TVs or anything else for that matter? How much do you think that the FMCG sector, your company included, will benefit on a durable basis, if at all?
Which is what I said as well earlier to your question, that I'm not seeing an immediate uptake. So people would not start, for example, using more skin cream or more dental products or otherwise on an immediate basis. It is on an overall economic sentiment for consumer companies, especially on, consumer durables will certainly tend to benefit more. Because as you do see that multiple number of consumers have postponed their purchases to, do it after the price reduction is fully passed on to the consumers. But my sense is that overall, once there is more income in the pockets, once there is saving, there should be some uptake. And that's why I've said it's not going to be entirely, large numbers will start moving in. But yes, certainly overall, what we saw very distinct slowdown in the urban consumption, and for several quarters. And we saw some, increase in the consumption in the rural areas. But broadly, my sense is that any kind of saving of this kind, 30% is very substantive saving in terms of cost reduction what the consumers will have, should increase to sales, the demand for the latent demand, which is there already in the with the consumers. I think it should certainly benefit. We are estimating it should be about 400 basis points, and which is pretty much a normal expectation that consumers would tend to consume more, perhaps, be incentivized to experiment more with the newer product launches that might be done, or increase their basic consumption, which we saw a distinct slowdown prior to, in last almost, 5-6 quarters we have seen that the urban demand was slowing down. I think that should start to pick up.
Take that point, Mr. Asthana. Thank you so much for joining in and giving us an outlook on that. To your point, Surbhi, we had Mr. Sanjeev Asthana's namesake, Sanjeev Mehta, join in on Friday. He said that instead of looking at what individual companies benefit, etc., just look at what the government has foregone in terms of revenue. That will be a little over 40,000 crores. What his assumption is that a little more than that 40,000 crores will come back in the form of consumption, because that would be at an aggregate level. So if you look at your consumption component in the GDP, that should increase by upwards of 40,000. Where it goes, how it goes is something
we have to see.
that, we'll know. And the other part is that
beauty salons, you don't know where that
and even in the
goes,
staples,
right?
the volumes will actually increase optically in the staples for the simple reason because nearly 30 to 40% of our sales value comes in from price point packs, which is 5 rupees, 10 rupees or 15 rupees. And when you're buying a 5 rupee biscuit, you are consuming that entire pack. Or when you're buying a 1 rupee, 2 rupee shampoo sachet, you are consuming that entire pack in one go. Just because there is, one extra biscuit or a few grams more of shampoo does not mean that you will save up on that. So incrementally, there would be volume growth coming in on those price point packs itself. But be that as may, what we'll do is we'll take a short break, come back, continue our consumption conversation. And this time around, we have Rajiv Rajgopal of AkzoNobel joining in. There is a consumption boost that is likely due to GST cuts. Does that happen on paints itself or not? Rajiv will answer that. And whether competitive intensity has come down or not, how does life feel after JSW deal? All these questions we'll pose to Rajiv Rajgopal at the bottom of your screen right now. Comes back after this short break.
Welcome back. You're with us on Corporate Trader. We are tracking, of course, a lot of the corporate commentary, and we're focusing on GST really today and what that is going to mean for the consumption sector. The next company on our radar is Akzo Global. Mr. Rajiv Rajgopal, Chairman and Managing Director at AkzoNobel, is with us. Mr. Rajgopal, thanks so much for joining in. Of course, focusing on three key points, we definitely want to understand what your interpretation is of these GST cuts and what it really means for the paint sector. And then, of course, we're looking at the company's strategies of tackling intense competition in the market. And, of course, want to get an update on the integration with JSW Paints. So thank you very much for joining. And actually, let me start with the last point first, because, there is a lot of, corporate change in the works now. It's been a little over 2 months since the deal was announced. So where are you? If you could just understand in terms of the integration, any change in employee structure, and have the talks on strategy really started in terms of what the strategy of the entity is going to be, which kind of gives us a segue into the other question as well about heightened competition in the paint space.
Morning, Surabhi. Morning to you, Nigel, Prashant, and to all the viewers. Thank you for having me on the show. Coming to the JSW integration, it's very early days, as you would understand. We are right now under CCI. So from both ends, we have certain limitations on what we can do, what we cannot. What's allowed is to look at the structures, etc. The current view is that, look, at this point of time, we intend to keep the two, and this is what Mr. Park Jindal has categorically stated, that, look, we intend to keep the two organizations for a period of time, 2-3 years, running separately, understand how to really integrate it well, and then start moving on the integration. So that's what has been outlined. But the tracks will really start once we get the CCI clearances, hopefully this month or early next month. Once that starts, then some deeper conversations will come in, Surabhi. So it would be a little early for me to really comment on it. I think it's best that Mr. Park Jindal talks about it. And I think we would be in a better position to really talk about it sometime around November. December is, in my view, the most optimal time.
All right. Rajiv, hi. Good morning. Prashant here. So you can, when we can't do too micro, we can go a little macro-ish, but still numbers, I guess. So you said, right, I mean, 2-3 years, and of course, it's going to be work in progress, and it's only the broad outlines, a couple of years to be run as separate businesses, and we will see how it goes. But the big numbers, what are you talking about? What are the numbers being talked about internally? Where would, obviously, JSW would want, the business to gain a lot of market share. You've got superb brands, but market share, of course, has been relatively small. In that sense. So you'd want to leverage that. So from 4-5 odd % currently, where would you, what's the number internally? Where would you want this number to go, over the next 3-4 years?
So, Prashant, very clearly, I think you're absolutely right. I think the first task is to really scale the company up. And the brief is to say that, look, let's try and scale the company and do it in a manner which is structurally right, which means that, it's not a blip and then you again run into an issue. So strategically put the roadblocks. And you're right, the 3 levers of that is going to be around spending more on the brand. You've seen that. We've already started it as we speak. Just a few days ago, we've just announced our Dulux Assurance 2.0 or 3.0 actually, with Lage Shandar, a campaign that we've Chale Shandar, Lage Shandar campaign. We were the first to come with that, and really that's our first to remind viewers that, look, I think our paint has got the best quality, undisputed. This is what consumers, dealers and painters say. So really, how can we really scale it up? And the target there is to really start seeing how quickly we can move to the number 3 position. So that's obviously to take it to about 7.5% really, and then try and then build it, as a paint and coating company to say how can we in the next 3 years start targeting the 10,000 crore. I think those outlines were already stated to you in July to both you and Nigel when Mr. Parth Jindal sort of addressed the gathering, and we are very clearly going to be working on those targets to make sure that we lift the brands in terms of scale. The challenge for us, Prashant, has been that obviously when, given the way AkzoNobel runs its portfolio, was that we were largely premium focused. And you're right, there's a huge amount of goodwill that Dulux enjoys, and we are under leveraged in the mass economy categories where, they are largely representative. Mass economy constitutes about 35% of the paint market, and we've got about a 1 to 2% market share. So really, how are we scaling that up? And that's where we're really working on. We've entered very well into a waterproofing segment. Our products are fantastic. We are now going to enter the construction chemical segment in a meaningful manner as we start playing around. But the brief is to say that we will not leave any category, and we will not leave any consumer segment or customer segment or price segment moving forward. So that will give you a idea of across both the paints and coatings business, how we as a team are gearing ourselves for the time ahead.
Got that. So immediate revenue market share target of close to 7.5%. and maybe move to about 10,000 crores, as you had pointed out earlier as well. Rajiv, this is Mangalam here. Just wanted to know, a couple of more things as well, because Mr. Jindal had said that time that they see immediate revenue synergies once both your stocks are in each other's supply pipeline, could be anywhere between 700 to 1,000 crores. The additional elbow room that they get for, marketing, close to 350 basis points as well. And I saw you speak about, your warranty. Warranty has been the big buzzword over the last, I think, 2 or 3 months, ever since Birla Opus came out with their, 1-year repainting warranty thing. Then the Asian Paints came out saying that we're here for more than 1 year. So obviously our warranty lasts beyond that. And then there is competitive intensity, which is fairly high. So how's that in the market right now? That's one. And secondly, on the GST part, while there was no explicit announcement for the paint industry, do you think when you look through the fine print, there have been some changes or reduction in other aspects would leave more money in the hands of people, and as a result of which they would go back to painting their houses? How should one look at it?
Yeah, so to your second question first, yes, the answer is GST. There has been no direct impact because paints was already at 18%. But as you've been sort of saying, I think the first thing is it's good that the essentials have got corrected, which gives more disposable income to discretionary. And as a result, we do think that paint will be a beneficial for this entire segment. Remember that if you look at this quarter, and if we're starting from May, there have been heavy rains. I understand even today, Mumbai has got heavy rains, right? Yep. So I think the painting cycle has seen a deferment. You should know that this quarter, Diwali is on 20th October. So as a result, this season is quite a truncated season. But when I work the markets, when I've been traveling across, what I see is we're going to have a fantastic Q3 and Q4. So to my mind, consumption should come back. The reason is the last blip really happened in 2022. And remember, the painting cycle typically for exterior is about 4 to 5 years, and interior is 3 to 4 years. So you're right now sitting in that sweet spot between this year and next year, when a lot of the places that went for painting will come for repainting, and we are positioning ourselves to sort of gear for it. Yeah. Coming to your first question, look, it's a little early days, Mangalam, and I think this is an ongoing conversation that we will have, because look, we've got to go through the nuggets of the integration plan. As I said, we need the CCI. The broad numbers you gave are indicative. We'll need to get into the nuggets, but you're right. Look, I think there are two different models that we have on our sales system. Axos moved into a distributor system. JSW Paints is a direct system, and there is a lot of value unlock. Once we agree to what the strategy is, there's also going to be 60% of our consumption is raw material. And I think the benefit of the combination will give us scale, and we will relook at some of the terms we have and see which company has got better terms. So there will be a little bit of value unlock in some of those activities, and also trying to make sure that we get closer to our customer. I think the first task is to mentally make that switch, Mangalam, which is to say that, look, we are no longer just going to be a premium brand, but we are going to be now addressing all consumer segments. It's about winning the micro battles in India. And it's about saying, because each segment operates very differently, and it's fantastic. I think it's exactly what I think the brand Dulux wanted, which is the reason why we went in for this. And
we take that point entirely, Rajiv. We take that point entirely, and I think we'll require you to join us. We request you to join us once the CCI approval comes in, and then you'll have more clarity on what you can speak about and what you're going to do going forward, etc. But just on the point of the next 2 quarters looking extremely strong for you, before we spoke after your first quarter numbers, you said you're at least targeting high single-digit growth this year, and if all things are good, you're looking at double-digit. Between that to now and the optimism that you have for the next couple of quarters, do you think that optimism has moved from high single-digit revenue growth to double-digit, or you still are maintained at high single-digit?
No, I would maintain a single-digit growth right now. The simple reason being that, when I travel, I still think there is a little bit of lag in terms of the consumption that I see. What's happened is some of the new entrants have obviously taken share from the existing ones, which is evident when you look at the quarterly results. We had a bit of a blip last quarter, but I'm glad to say that, I think Dulux is back. I think with the entire strategic review and now JSW being announced as a winner, very clearly there's a lot of positive feeling in the market. We are getting super aggressive because that's the task that we've been given, and I think it'll take a bit of while to really make sure that the flight takes off. But I am fairly confident that going forward that the single digit can be converted, because we believe that we've got the right the mix, we've got the right strategies in place, and it's about saying we need to find chisel certain areas that we need to fine tune.
Absolutely. And we look forward to that conversation after November, December, Mr. Rajgopal, like you said. Just in the extreme near term, because you mentioned rains, will Q2 this year be worse off than last year Q2, just because of the incessant rain? You mentioned, the impact obviously on the timelines getting deferred. So in the extreme near term, has there's been a washout season because of the heavy monsoon?
Look, I can compare it, Surabhi, to last quarter, and it'll be better for us than the last quarter. But from an industry perspective, I think it'll be quite similar to the last quarter, primarily because of the heavy rains that happened in August, September. But again, monsoon has started retreating in the last few days in certain parts of the country. So we'll see. We are going to put our best foot forward. But suffice to say, I think it'll be a little better than the last quarter, but not dramatically different.
Sure. So last quarter of last year, you mean? Year on year, it'll be slightly better than the last season.
I was talking of the first quarter.
Q1,
quarter. Yeah,
okay, it'll be slightly better than Q1. Got it.
Better than Q1, but it will not be dramatic because, still remember that on the profitability side, we've also had the ad, which has got on the TiO2, which has taken a bit of sheen on the raw material pricing. Yeah. That said, I think for us, we see it slightly better than the last quarter, but let's see. I mean, I think it's not fair for me to comment on the current quarter, but from a long-term perspective, as I told you, we are fairly confident. Even in our coatings business, our order book hasn't dramatically shifted, right? It's just a time lag of certain projects that got executed last year this time, which is coming now in October, November. So, it's just a timing issue. I don't see too much of a structural change.
All right. Rajiv, a good conversation. Thank you very much as you continue to execute. Appreciate your time here on CNBC-TV18. Thank you. All right, well, 20 points lower, so it's very, very quiet this morning. 25,091 is where the Nifty is now trading at. Vinay Rajani is Senior Technical and Derivative Analyst at HDFC Securities. He's with us. Vinay, good to have you with us. Thanks very much for your time. Flat after about 700 points in the last 8 days. But, I mean, it's buoyant. 1,800 stocks are higher, about 1,000 stocks are lower, so enough single stock activity. How would you play it?
Yeah, good morning and thanks for having me on the show. So broader markets have started participating well, and gradually Nifty has been improving on the charts. Last week we saw that it has formed a higher top, higher bottom formation on the weekly closing basis. So that's a good sign, and positional trend has changed to bullish side. And we have been bullish, and some sectors were performing and outperforming, and now other participation is also coming today. PSU segment started doing well. So gradually the broader markets are getting strength. We are trying to catch up with the global and emerging markets. That's a good sign. So overall view is positive. Dip should be bought into 24,900 to 25,000 is a very strong support, and ultimately we are targeting a immediate target of 25,500 in the Nifty. So overall setup is quite good, and we should participate in this market even if Nifty consolidates here, because it has been 8 days consecutive sessions rise. So it might happen that index may consolidate for a while, but stock specific bullishness will continue, and the broader market will participate very well in the market. So overall we are bullish, and immediate target for the Nifty should be 25,500, and 24,900 to 25,000 should be the buying range.
And your stock picks?
Yeah. So PSU, as I said, started doing well. Some fresh breakouts on the charts. One of the stock is Indian Renewable Energy, IRDA. IRDA is placed around 150, 1.5, 152. So around that one can go long. I would suggest a stop loss at 146. On the upside, I'm expecting a target of 160. The second pick also I'm taking from the same segment, the PSU, the HUDCO. So HUDCO is looking quite strong, fresh breakouts on the charts, good outperformance with the volume. So 222 is the level around which one can go long. I would suggest a stop loss at 215. On the upside, I'm expecting a target of 230.
Yeah. Thank you very much, Vinay. Appreciate it. And we'll speak again shortly. So 35 lower, 25,000 and 80 or so is where the index is at. Manisha is going to be coming up on the other side with what's top of mind for the commodity space. Stay tuned.
It's a quiet morning for the equity market, but let's find out what's happening in commodities. Manisha is here with us. Manisha, good morning. So what's the big headline for you?
Well, I'm looking at silver prices really because almost everybody seems to be buying into this one. Speculative, futures, central banks, industrial markets, all of that seem to be betting very, very big on silver. And that's exactly what we have seen as well. If you look at last 1 month this year, silver has given you very, very strong returns, best in many, many years there. And the traders are betting in 25 basis point rate cut in the next week in September from the US Fed, a start of the rate cut cycle really. And that has been supportive for various commodities. But silver is trading at a 14-year highs in the international markets, and we are looking at all-time highs in the Indian markets as well. If you look at the US consumer prices, that gained a buy in the month of August, fastest pace in 7 months. And the other one to watch is the jobless claims. That also has seen highest since 2021. So markets really seem to be getting ready for that rate cut there. For the demand side of it, well, industrial demand is quite strong, whether it comes in from solar, EV, AI, electricals, electronics, you name it, and silver is in demand on the stronger side there. Also, when you look at the overall market, really, 50% of demand really seems to be coming in from industrial market at this point in time. Well, it also is about production deficits and strong demands coming in. On-ground inventories also have continued to decline. Gold-silver ratio has been very, very supportive also. And then it has been about physical retail investment also. The gold to silver ratio has been on the positive side, telling you that the silver prices can go higher from here. And then it is about portfolio diversification, strong investment via global ETFs, ETPs, physical buying, and then, of course, there is very, very strong central buying coming in as well. So when you look at the global silver production numbers, well, it is estimated at 800 million to 1 billion ounces, while demand is expected at 1 billion to 1.2 billion ounces for 2025. And this is a fifth straight year, and markets anticipating for the next 2 to 3 or 4 years as well, you could be looking at this deficit continuing. That has been supportive for silver. This is a very interesting trend that the markets are working with. There is a shift from paper trading to physical possession or holding among large institutional players, family houses, also supporting silver there. And the next best thing really has been central bank buying. You know, it was until since 1970s that the central bank stopped acquiring silver because, one, it took 80 times more space than gold, was very volatile, was a smaller commodity. But now we have seen all of this really turn around. If you look at silver now, the central banks are really buying it. The dollar-denominated assets, while we are looking at sanctions in there, also seems to be supporting silver from where it stands. So when you look at the overall numbers, silver does seem to be getting recognition as a precious asset class, which central banks also want to start buying into. So some countries which already have started this is Russia. They have allocated nearly $535 million for the next 3 years. This is for allocation of precious metals, and silver does stand a very, very strong number here. The second country really is about Saudi Arabia. They already have acquired 9 lakh shares in iShares Silver Trust. So Saudi Arabia is not buying it in physical. They are investing into silver via ETFs, but you can always redeem it, remember, and that is what they perhaps are looking at as well. China reportedly is purchasing silver concentrate directly from miners in Latin America. This is a concept that a lot of experts tell us that countries are doing, buying it directly from miners, so you don't have those kind of numbers available there. The other one, of course, is about the BRICS nations. There have been discussion in the last couple of meetings on precious metals as part of potential new reserve asset frameworks. Very supportive. And then when you look at India, we are one of the major buyers here. 3,000 tons of silver is what India already has imported in the first half of 2025. The numbers only expected to increase in the second half as well. And let's finally get the numbers on you in sense of prices. And $49.5 an ounce is an all-time high that we saw in 2011. And before that, this price was seen in 1980. Currently, silver is trading at 42.5, not too far away from these levels, with an expectation that we perhaps could be making all-time highs in this year itself. So when you look at the chart for the Indian markets as well, it has been doubling of silver prices every 5 years. We stand at an all-time high of 1,29,000 rupees per kg right now. In 2020, it was 68,000. So as you can see, every 5 years, we've seen silver prices double up. And the final chart should show you in percentage terms on what we have seen in silver returns. So this perhaps is the best year that we have seen in last 7 or 8 years in sense of returns that silver has given. 46% higher right now. The last time it gave negative, the last time it gave negative in 15 years was perhaps in 2021 only. But silver, clearly that glittering white metal.
Silver is the new gold. That's what everyone's talking about. You know, this morning we had Adani speak about Bitcoin as the new gold, but silver definitely doing a lot better as gold prices get, fairly expensive. But importantly, now, as Manisha pointed out, a lot of these nations putting silver in their treasury basket as well, or allocating money to buy silver as their precious metal basket as well, shoring up family silver, as they say. But one of the stocks on our radar is Shakti Pumps. Vamakshi joins in to tell us more about that. But before going to Vamakshi, just look at Vodafone Idea, up around 6%. There was a flash that came by. September 19th is where the Supreme Court registry has been made to make a hearing on the AGR plea. Now, this does not mean that that will be accepted or not. Usually these events are fairly binary. The street is going fairly optimistic into that one. In fact, over the last month or so, the stock has rallied about 32%. So, on a low base, we'll watch out for how what the outcome of that Supreme Court hearing on that AGR plea would be. September 19th is the date to keep on your radar. But Vamakshi, Shakti Pumps.
Well, Shakti Pumps is doing quite well in trade today. Now, keep in mind that the company has received extremely strong response for its water pumping systems. Now, they received a letter of empanelment from the Maharashtra State Electricity Distribution Company. This was on August 12th, and this was for supply as well as installation of nearly 34,720 off-grid DC solar photovoltaic water pumping systems. Now, this was under the Magel Tyala Saur Krishi Pump Yojana, or the PM Kusum B. Now, on August 27th of this year itself, the Maharashtra State Electricity Distribution Company had opened its portal for the first tranche of the 10,000 water pumping systems, and this was fully booked by the farmers in just 1.5 hours. This is something that the company had reported earlier, and the total value of this tranche was somewhere around 269 crores. Now come to the announcement made by the company over the weekend. Now the MSEDCL had opened the portal for the second tranche, and this was for 12,451 water pumping systems. Now this again was fully booked by the farmers, and the tranche value that they had was around 347 crores. So therefore, these two tranches in a very short span of time have managed to push the order book of the company by around 616 crores. And as of August 1st, the order book stood at 1,350 crores. So huge boost coming in to the order book, and resultantly the stock is higher in trade today.
Okay, all right. And Shakti has done well, and some of the recent ones, right? Oswal Pumps, etc. And there are a few more coming to the market shortly. In the same space. Vamakshi, thank you very much for that. That's Shakti for you with the specific focus. Time for a break. On the other side, it's a special segment. It's the economy. Latha speaks with Krishnan Sitharaman of CRISIL Ratings on the robustness and growth prospects of the banking system. Stay tuned. Coming up.
Welcome to It's the Economy. While the Nifty Bank is down about 5% from July 1st, in the month of September, it is up about 2%. Rating agency CRISIL, in its annual report on banks, says that bank credit growth can jump to 11 to 12% this year from the under 10% that it is clocking in the first half, April to August. They, however, see another 15 basis point pressure on bank margins this year, and also advise some caution on unsecured loans. Otherwise, they say asset quality is very good. But that's some of the key highlights. To get a comprehensive view of CRISIL's view on banks, their profits, their asset quality, that will pan out. I have with me Krishnan Sitaraman, Chief Ratings Officer at CRISIL Ratings. Krishnan, thank you very much indeed for joining me. While you have put in, added on many dangers in terms of cyber risk, etc., I think now we should add weather risk the way Bombay is treating us today. But, OK, to come to your report itself, you're confident of an 11 to 12% credit growth this year. Is that a full year average, or is it 11 to 12% for second half?
A very good morning to you, Lata, and good morning, everyone. Thank you for having me on the show. So the 11 to 12% number is for the full year fiscal. So we have seen, as you mentioned, somewhat muted credit growth in the first quarter of the year, which came in at around 10-odd%. So we do expect pick up in the second half of the year, and that would be mostly driven by the retail segment. We do expect consumption-related credit to go up because of the number of tailwinds which have come in, both from the government side as well as from the regulators. So the tax cut, the GST rationalization will definitely help. In addition to that, the personal income tax rationalized cut in the beginning of the year, that will play out. We also have a low interest rate regime, a low inflation regime, and the monsoons, the normal monsoons, the weather that you talked about, that is helping rural incomes pick up. So all that will help to enhance consumption level. Retail credit should move up, and that will drive the overall credit growth. The other segments would be more or less range bound.
OK, I'll come back to credit growth, time permitting, but more importantly, how do you see margins? Because it appears now that the inflation numbers are coming in lower than forecast. The forecast for the number that came on Friday was 2.2. That's the CNBC-TV18 poll. It came in at 2.07. This is about the third or fourth month in a row that inflation is undershooting. And we have not even factored in the CPI, the GST cuts. So, most people are expecting inflation to undershoot. If there is another rate cut, what may be the hit to bank margins?
So we have factored in another 25 bips cut during the course of the fiscal. Having factored that in, we believe that bank margins would be less by around 5 to 15 basis points vis-a-vis last fiscal. Last fiscal was a nearly all-time high in terms of ROAs that the banks displayed. That was at 1.4%. This fiscal, we expect that to come in at 1.25 to 1.3 odd percent. And in the first quarter, if you see the numbers that are around a little over 1.3% ROA, that did get some benefit from treasury income because of the falling interest rates. Now that will level out during the course of the year. But in general, if you see historical track record, because the structural construct of a bank's balance sheet, when interest rates start going down, the lending book reprices downwards almost immediately, whereas the deposits reprice with a lag. So in the initial period of the interest rate cut, the profitability does take a hit. At the same time, there is some offset provided by the treasury book or the investment book, which shows an appreciation when interest rates start coming down. On the whole, factoring in another 25 bips cut, we do expect margins to be down by around 10 odd basis points. 5 to 15 basis points is the range that we are giving.
OK, fine. But what is more impressive is that you are expecting the return on assets, the ROA, to remain very good. I think your ROA is 1.3%. Very good, just marginally lower than 1.4. Have you factored in the fall in bond prices? I mean, this quarter, in Q1, banks lost on margins, but they got a lot of reprieve from higher bond prices. This time it is going to get reversed. In spite of it, you think they will report good ROAs or profits?
Yes, very good point that you bring out, Lata. What will happen is, yes, with the interest rates, we see that interest rates have somewhat moved up this quarter. That would have an impact on the treasury book, but that will be more than offset by the lending book versus deposit spreads kind of offsetting that. So we do believe that because the lending book is a larger book as compared to the investment book, the impact of the investment book will not overshadow that of the lending book. So that's the overall construct. If that marginal increase in interest rates were not seen in this quarter, we could have had a higher inch up in the profitability.
Okay, well, I hope that it works out that way because the bond book was the only thing that was liberating the banks. Let me come to asset quality. You are largely benign in your assessment of asset quality. You know, corporate loan book is excellent. But what about MSMEs? We haven't heard much, but last quarter, you know, I think ICICI's MSME loan book grew by 29%. If I'm not mistaken, HDFC banks grew by some 17-18%. For all of them, MSMEs are huge providers, and yet you saw Bajaj Finance giving us almost a heart attack on MSME asset quality. So, I mean, since banks have lent big, are you confident of MSME asset quality?
So MSME is the only segment where we believe that the NPAs will move up a touch. At the same time, if I look at the banks' books, as far as MSMEs are concerned, their quality of the portfolio is somewhat better than the NBFCs. And if I look at the overall banks plus NBFCs lending to MSMEs, we see an inch up in NPAs in the segment which is less than 1 crore, where the loan exposure is less than 1 crore. The other segments, NPAs are range bound or even improving. And the other angle here is the export-oriented MSME. They will also face a challenge in terms of the NPAs. But when we see the overall mix of the MSME exposure, a bulk of the less than 1 crore exposure is from the NBFC side. What is sitting on the banks is much less. So when we see the overall bank exposure to MSMEs, the NPAs came in around 3.6% as of March of 25. We expect that to go up by maybe around 20 to 25 bips during the course of the year. There will be some increase in the MSME NPAs, but overall, if I look at the profile of the NPAs which MSMEs that the banks lend to, that's relatively better.
Okay, fair point.
And banks are also having another tailwind on the MSME side with increasing formalization and digitalization. Ability to evaluate MSMEs has gone up.
Okay. I'm sorry I'm interrupting you because I have only a minute left, but I want to ask you about the deposit profile. You give some very interesting statistics that bank deposits are now being held less and less by households and more by corporates. What are your fears and your observations? But a little quickly.
Yeah. So in the last 5 years, we have seen household share of deposits come down from around 65% to 60%, around 5% decline, but that 60% is still held by the households. The change, the delta of 5% has gone to non-financial corporates, and that is because they are sitting on a huge pile of cash. The cash surplus in large corporates in India, that has gone up, and that this is one area where they are deploying it. So the surplus liquidity is getting deployed in the banks. But what the issue that could result there is a higher level of volatility, because if there is another avenue where the corporates can deploy that, or if there are capex plans coming up, then that can go out. So the stability of that deposit will be lesser than the household deposits. Okay. But still that shift is not too much.
Okay, well, on another day, I want to know whether this will mean that banks will be less able to finance longer-term projects because they don't have stability of deposits. But that debate for another day. Krishnan, thank you very much for joining me despite the weather plotting against you. We do hope you have a great conference out there on banking. Thanks for joining us. Wrap up on Bazaar on that note. Chartbusters coming up.